Starting a business is an exciting journey, but one of the first hurdles every entrepreneur faces is securing the right funding. Whether you're launching a small startup or expanding an established company, understanding your financing options is crucial. In this video, we'll walk you through the various ways you can fund your business, from traditional loans to innovative alternatives. By the end, you'll have a clearer picture of which path might suit your goals best. Let's begin by exploring why funding is so important for business growth and sustainability. Funding is the lifeblood of any business. It allows you to purchase inventory, hire staff, market your products, and cover daily expenses. Without adequate financing, even the best business ideas can struggle to get off the ground. Proper funding also provides a safety net, helping you weather unexpected challenges and seize new opportunities. As we move forward, keep in mind how each funding option can impact your business's flexibility and growth potential. Many entrepreneurs start by investing their own money into their business. Using personal savings is often the quickest and simplest way to get started, as it doesn't require approval from banks or investors. However, it also means taking on all the financial risk yourself. Before dipping into your savings, consider how much you can afford to lose and whether you'll need those funds for personal emergencies. Let's look at the pros and cons of this approach. Another common source of funding is borrowing from friends or family. This option can be more flexible than traditional loans and may come with little or no interest. However, mixing business with personal relationships can be tricky. It's important to set clear terms and put agreements in writing to avoid misunderstandings. Always treat these transactions professionally to protect both your business and your relationships. Additional bank loans are a popular choice for many business owners. Banks offer various loan products, from short-term working capital loans to long-term equipment financing. To qualify, you'll need a solid business plan, good credit, and sometimes collateral. While bank loans can provide significant capital, the application process can be lengthy and competitive. Let's explore what banks typically look for and how you can improve your chances of approval. Credit unions are member-owned financial institutions that often offer more favorable loan terms than traditional banks. They may be more willing to work with small businesses and startups, especially if you have a relationship with them. However, you'll usually need to become a member and meet certain eligibility requirements. Credit unions can be a great alternative if you're looking for personalized service and lower interest rates. Grants are funds provided by governments, foundations, or organizations that do not need to be repaid. They are highly competitive and often targeted at specific industries, demographics, or business goals. Applying for grants requires thorough research and detailed applications, but the reward can be substantial. If you qualify, grants can provide a significant boost without adding debt to your business. Angel investors are individuals who provide capital to startups in exchange for equity or convertible debt. They often bring valuable experience and connections in addition to funding. However, giving up equity means sharing ownership and possibly decision-making power. It's important to find investors whose vision aligns with yours and to negotiate terms that protect your interests. Venture capital firms invest in high-growth startups with significant potential. In exchange for large investments, they typically require a substantial equity stake and may take an active role in management. Venture capital is best suited for businesses with scalable models and ambitious growth plans. The process is competitive and not all businesses will qualify, but for those that do, the rewards can be transformative. Crowdfunding platforms like Kickstarter and Indiegogo allow you to raise small amounts of money from a large number of people. This approach can also help validate your business idea and build a community of supporters. However, running a successful crowdfunding campaign requires marketing skills and a compelling story. It's important to set realistic goals and deliver on your promises to backers. Peer-to-peer lending platforms connect borrowers directly with individual lenders, often online. These platforms can offer more flexible terms and faster approvals than traditional banks. However, interest rates may be higher and you'll need to present a convincing case to attract lenders. Peer-to-peer lending is a growing option for entrepreneurs seeking alternative financing. Microloans are small, short-term loans designed for startups and small businesses. They are often provided by nonprofit organizations or government programs. Microloans can be easier to qualify for than traditional bank loans and are ideal for covering initial expenses or bridging cash flow gaps. However, the loan amounts are usually limited, so they may not be suitable for larger projects. Business credit cards can provide quick access to funds and help manage cash flow. They are especially useful for covering short-term expenses or emergencies. Many cards offer rewards such as cashback or travel points. However, high interest rates can add up quickly if balances aren't paid off each month. Responsible use is key to avoiding debt problems. Business line of credit allows you to borrow up to a certain limit and pay interest only on the amount you use. This flexible option is great for managing cash flow fluctuations or unexpected expenses. Lines of credit can be secured or unsecured, and approval depends on your creditworthiness. They offer ongoing access to funds, making them a valuable tool for many businesses. If your business needs expensive equipment financing can help you purchase it without a large upfront payment. The equipment itself often serves as collateral, making approval easier. This option allows you to spread the cost over time, preserving your cash flow for other needs. It's especially useful for businesses in manufacturing, construction, or transportation. Invoice financing lets you borrow against unpaid invoices, providing immediate cash flow while you wait for customers to pay. This option is ideal for businesses with long payment cycles or seasonal fluctuations. While it can be more expensive than other forms of credit, it helps you maintain operations and meet obligations without waiting for payments to come in. Merchant cash advance provides a lump sum in exchange for a percentage of your future sales. This option is fast and doesn't require collateral, but it can be expensive due to high fees. It's best suited for businesses with steady credit card sales that need quick access to cash. Always review the terms carefully before accepting a merchant cash advance. Trade credit is when suppliers allow you to buy now and pay later, usually within 30 to 90 days. This can help you manage cash flow and build relationships with vendors. However, late payments can damage your credit and supplier trust. Trade credit is a valuable tool for businesses that need inventory or supplies before they have the cash to pay up front. Many governments offer programs to support small businesses, including loans, grants, and guarantees. These programs often have favorable terms and may target specific industries or groups, such as women or minority entrepreneurs. Researching local, state, and federal options can uncover valuable resources to help fund your business and reduce risk. Business incubators and accelerators provide funding, mentorship, and resources to startups. In exchange, they may take equity or require participation in their programs. These organizations can help you refine your business model, connect with investors, and accelerate growth. If you're looking for more than just money, incubators and accelerators offer a supportive environment for early-stage businesses. Forming strategic partnerships with other businesses can provide access to funding, resources, or new markets. These partnerships often involve sharing profits, resources, or expertise. It's important to choose partners whose goals align with yours and to establish clear agreements. Strategic partnerships can help you grow faster and reduce costs, but require trust and communication. Some suppliers offer financing options to help you purchase inventory or equipment. This can include payment plans, deferred payments, or leasing arrangements. Supplier financing can ease cash flow pressures and help you scale operations. Always review the terms and compare offers to ensure you're getting the best deal for your business. Revenue-based financing allows you to repay investors with a percentage of your future revenues, rather than fixed payments. This flexible approach adjusts to your business's performance, making it easier to manage during slow periods. However, it can be more expensive in the long run if your business grows quickly. It's a good fit for companies with predictable revenue streams. Bootstrapping means building your business with minimal outside funding, relying on your own resources and revenue. This approach gives you full control and avoids debt or equity dilution. However, it can limit your growth and requires careful budgeting. Bootstrapping is ideal for entrepreneurs who value independence and are willing to grow slowly and steadily. Some business owners use home equity loans to fund their ventures. This involves borrowing against the value of your home, often at lower interest rates than unsecured loans. While this can provide significant capital, it puts your home at risk if your business fails. Carefully consider the risks and consult with a financial advisor before using this option. Some retirement accounts allow you to borrow money to fund your business. This can be a quick source of capital, but it comes with strict rules and potential tax penalties if not repaid on time. Using retirement savings for business is risky, as you could jeopardize your future security. Always weigh the pros and cons before tapping into retirement funds. If you're buying a franchise, some franchisors offer financing options to help you get started. This can include loans, deferred fees, or equipment leasing. Franchise financing can make it easier to launch your business, but it's important to understand all the terms and obligations. Compare offers and seek advice to ensure you're making the best choice. Export financing helps businesses that sell products or services internationally. This can include loans, guarantees, or insurance to manage the risks of global trade. Export financing can help you expand into new markets and manage cash flow, but it often involves complex regulations and paperwork. Specialized lenders and government programs can provide valuable support. For larger, established businesses, raising capital through an initial public offering, IPO, or public markets is an option. This involves selling shares to the public, providing significant funds for expansion. However, going public is a complex, expensive process that requires meeting strict regulatory standards. It also means increased scrutiny and loss of some control. Convertible notes are a form of short-term debt that can convert into equity at a later date, usually during a future funding round. This option is popular with startups seeking early-stage investment without setting a valuation. Convertible notes can be complex, so it's important to understand the terms and consult with legal and financial advisors. Royalty financing allows you to raise funds by promising investors a percentage of your future revenue, usually from a specific product or service. This can be less risky than equity financing as you retain ownership. However, royalty payments can add up over time, so it's important to project your future sales accurately before committing. Community Development Financial Institutions, CDFIs, provide loans and support to businesses in underserved areas. These funds aim to promote economic growth and job creation in local communities. CDFIs often offer flexible terms and additional resources, making them a great option for businesses that may not qualify for traditional financing. Factoring involves selling your accounts receivable to a third party at a discount in exchange for immediate cash. This can help you manage cash flow and reduce the risk of bad debts. However, factoring can be expensive, and you may lose some control over customer relationships. It's important to weigh the costs and benefits before choosing this option. Some grants are specifically aimed at businesses developing new technologies or innovative solutions. These grants can provide significant funding and recognition, but the application process is often rigorous. If your business is focused on research and development, pursuing innovation grants can help you bring your ideas to market faster. Online lenders offer a range of financing products, from term loans to lines of credit. These lenders often provide faster approvals and more flexible terms than traditional banks. However, interest rates can be higher, and it's important to research the lender's reputation. Online lending is a convenient option for businesses that need quick access to funds. Family offices are private wealth management firms that invest on behalf of wealthy families. They may provide funding to businesses that align with their values or investment goals. Family offices can offer patient capital and valuable connections, but finding the right fit can take time. Building relationships and demonstrating shared values is key. Some large corporations invest in startups through their own venture capital arms. Corporate venture capital can provide funding, industry expertise, and access to distribution channels. However, these investors may have strategic interests that influence your business direction. It's important to align your goals and negotiate terms carefully. The United States, the Small Business Administration (SBA) offers loan programs that guarantee a portion of the loan, making it easier for small businesses to qualify. SBA loans often have favorable terms and lower down payments. The application process can be detailed, but the support and resources provided make it a valuable option for many entrepreneurs. Green financing supports businesses focused on sustainability and environmental impact. This can include loans, grants, or investment from organizations that prioritize eco-friendly projects. Green financing can help you access capital while promoting positive change. If your business has a strong environmental mission, explore these specialized funding sources. Hybrid financing combines different funding sources such as loans and equity to meet your business's needs. This approach can provide flexibility and reduce risk by spreading out your obligations. Hybrid financing is often used by growing businesses that need both capital and strategic support. It's important to balance the terms and ensure you're not overextending your resources. Equity financing involves selling ownership shares in your business to investors. This can provide significant capital without the burden of debt, but it means sharing profits and decision-making. Equity investors often bring expertise and networks which can help your business grow. Carefully consider how much control you're willing to give up before pursuing equity financing. Debt financing means borrowing money that must be repaid with interest. This includes loans, lines of credit, and bonds. Debt allows you to retain full ownership of your business, but it adds financial obligations and risk. Managing debt responsibly is key to maintaining healthy cash flow and avoiding financial strain. So many financing options available, choosing the right one depends on your business's needs, stage, and goals. Consider factors like the amount of capital required, your willingness to share ownership, and your ability to repay debt. It's often helpful to consult with financial advisors or mentors to evaluate your options and make informed decisions. No matter which funding option you choose, preparation is key. Lenders and investors will want to see a solid business plan, financial projections, and evidence of your commitment. Take the time to gather all necessary documents and present your business in the best possible light. A well-prepared application increases your chances of securing the funding you need. Securing funding is a crucial step in building a successful business. By understanding the wide range of financing options available, you can choose the path that best fits your vision and needs. Remember to weigh the pros and cons of each option, seek professional advice, and prepare thoroughly. With the right funding, your business can grow, innovate, and thrive in today's competitive landscape.